There's a software company trading at $12 a share that just crushed its earnings, beat Wall Street by 167%, and Wall Street still isn't buying it. Freshworks. You probably haven't heard of them, but this is where things get weird. Everyone thinks the problem is that their AI product, Freddy, isn't working. That's not it. The real issue, the company is trapped in a money-burning loop that forces them to repurchase their own stock just to stay in the same place. And the founder just cashed out $39 million worth of stock. That's a red flag most investors totally miss. Freshworks is a cloud software company. Think customer support and IT service management tools. They went public in 2021, serve about 75,000 companies worldwide, everyone from Sony Music to Bridgestone, and they're profitable on paper. Non-GAAP. They've got $813 million sitting in cash, no debt, a fortress balance sheet. But here's the kicker. Despite all that strength, the stock has been getting crushed, down about 70% from its peak. And when they beat earnings in November, the stock barely flinched. Freshworks actually has solid fundamentals. Q3 2025, revenue hit $115.1 million, up 15% year over year. They're generating $180 million in operating cash flow. Margins are north of 80%. If you just looked at the income statement, you'd think this is a growth machine. Here's where it gets interesting. The founder and executive chairman, Rathney Krishmathrubbatam, executed 4 massive sales. He cashed out nearly $39 million worth of stock at prices that are down 70% from the all-time high. That's not a founder who believes in a recovery. That's not a founder who thinks his company is undervalued. That's a founder saying, I'm done waiting. Now, let me walk you through the structural problem most people miss. When Freshworks went public in 2021, they had about 96 million shares outstanding. Today, about 300 million shares. That's a 3x increase. Now you might think, well, the market must have grown or they raised a ton of capital. Nope, they authorized a $400 million buyback program and have actually spent $384.5 million buying back stock, 27 million shares repurchased. So they spent nearly $400 million buying back stock. The share count should have dropped. It didn't. It stayed roughly flat. That's like selling your car for less than the cost of the tires. They're burning hundreds of millions of dollars just to tread water. Here's the other twist. The company keeps beating earnings. Q3, they posted 16 cents in non-GAAP earnings per share when estimates were 6 cents. That's a massive beat. Massive. Stock barely moved. Then it trended down anyway. This is what analysts call fade the rally. Good news hits. Institutional investors use that liquidity to exit, and the stock drifts lower. It's happened 58% of the time after gap-up moves. The market is saying one thing clear. We don't care if you beat. We care if you're improving your core business. And you're not. You're just spending money to stay still. Now, this is where things could explode, or at least get a lot more complicated. Freshworks issued $402.5 million in convertible notes due 2026. That's coming due in less than a year. The conversion price is set at roughly $134 per share. The stock is trading at $12. So guess what's going to happen? Note holders aren't converting. They're demanding cash repayment. That $402.5 million obligation is going to cut the company's cash pile roughly in half, from $813 million down to around $400 million. Now, they can afford it. They have the cash. But that's half the strategic runway just gone. And it arrives right as growth is decelerating, now at 15% instead of 30% plus. So here's my take on what's really happening with Freshworks. The company isn't dying. It's not heading toward bankruptcy. It's not a fraud. It's not even technically a bad business. They're shipping real products to real customers, and those customers are happy. Customer retention is strong. Net dollar retention over 100%. But it's a value trap. Here's why. First problem, the dilution buyback death spiral. They're caught in a red queen race where they have to run as fast as they can just to stay in the same place. Their employees are compensated heavily in stock. Every quarter, shares vest. Every quarter, they have to buy back stock to neutralize that dilution. This is a structural inefficiency that's going to depress long-term value creation indefinitely. They're throwing capital at a problem that never ends. Second problem, insider lack of conviction. When the founder is selling $39 million of stock at depressed prices, that tells you something. It's not a sign of belief. It's a sign of I'm taking chips off the table because I don't think we're undervalued enough to stick around. Third problem. The 2026 debt wall is going to reduce financial flexibility. Right as growth is slowing, they're going to deploy $500 million to pay off convertible debt. That's capital that could have gone into product development or acquisitions. Instead, it's servicing legacy financial engineering. And if the macro environment deteriorates, if corporate IT budgets get cut, there's suddenly a mid-cap SaaS name with slowing growth and reduced cash. That's a bad place to be. Now, I'm not saying the stock can't go higher if AI adoption accelerates, if Freddy AI actually becomes a revenue driver. If they execute flawlessly for 2 years, they could prove undervalued. Consensus targets are around $19.44 per share, which would be a 60% pop from here. But that's not the base case. The base case is that you're buying a structurally compromised equity where management isn't aligned, dilution is chronic, and the company is treading water. That's a slow bleed, not a bang-bang catalyst. So here's what I want you to remember, because this is the part most people miss. Freshworks isn't a red flag fraud. The balance sheet is clean, the business actually works, the product is solid, but that doesn't mean it's a good investment. Sometimes the most dangerous traps are the ones that look the most legitimate on the surface. A company can be operationally sound and a terrible equity investment at the same time. This is what we call a value trap. It looks cheap, it beats estimates, it has cash, and yet the insiders are running. The stock keeps fading rallies, and the capital structure is quietly destroying shareholder value through 1,000 paper cuts. While everyone else is chasing mega-cap AI narratives, Freshworks is the cautionary tale about what happens when you confuse a good business with a good investment. And that's the part most people miss. I'm not saying stay away entirely. If you're a long-term believer in their AI roadmap and you can stomach volatility, there might be something here. But at $12, after a 70% decline, and with insiders heading for the exits, I'm passing. The risk to reward just isn't there for me. And hey, I hope this video helps you on your quest for profits.